On April 2nd, Trump announces a wave of reciprocal tariff, China being the biggest target. And it sets off a firestorm in the markets. The fear versus greed index hits extreme fear, showing just how panicked everyone is. Then the Dow Jones and S&P 500 tank hard. On April 3rd, the Dow drops nearly 1,700 points and S&P 500 fell nearly 5%. And then a few days later, Trump announces that he'll pause the tariffs for 90 days. And of course, the market bounces back a bit, but not fully. Then, just when things start to calm down a little bit, Trump suggests that he wants to fire the Federal Reserve Chair, Jerome Powell, and the market spirals down again, almost 1,000 points on Dow Jones on April 10th. But then soon after, Trump changes his mind about firing Jerome Powell. And through all these ups and downs, the dollar value drops and gold prices shoot up, gold typically being a classic hedge against a shaky currency. And fast forward to April 30th, the Commerce Department said the US GDP had a decline of 0.3% in the first quarter of the year. And traditionally, 2 consecutive quarters of negative GDP is a definition of a recession. So obviously, you may have noticed a lot of mixed noise and you might be feeling a little bit of an anxiety. And the chaos, the confusion might be leading you to feel out of control when it comes to your financial future. And if you're nearing retirement, this is something that you definitely don't want to see. But here's the thing. You and I both know that this isn't the first or won't be the last time we'll see turbulence in the economy. There will be more market shakeups and more events that we can't predict. And it seems like every 10 years or so, something big hits the economy. Think about the dot-com bubble in the early 2000s, the Great Recession in 2008, the COVID-19 pandemic in 2020, and each time, people felt the same fear that you're feeling now. So, are there ways to keep your money safe to come out of these storms untouched every time you experience it? Now, I can't promise that you'd be invincible, but what I can share are time-tested principles that can dramatically lower your risk to your financial future. So with that said, let's go and dive into 5 practical time-tested principles to help you through these types of times. First thing first, you might think that this is a great time to start making changes to your investment strategies, to sell and move your money to a safer opportunity, right? But I'm gonna tell you that this might be the opposite of what you might wanna do. It might actually do irreversible damage to your investment. So if you're invested right now in the markets, like in a 401k or IRA, do not panic and sell, especially if you're not retiring soon. I've seen way too many people pull out during a dip and regret it later. In a typical cyclical manner, markets tend to bounce back even after big drops that we've seen early in April. For example, after the Dow Jones had fell almost 1,700 points on April 3rd, it gained 800 points just a few days later. And if you're getting closer to retirement, you should already have safer allocations away from equities or stocks. But in turbulent times like these, the worst thing you could do is to make irrational moves. The only reason why you lose money in these seasons is if you choose to sell. Now, I'm talking about it in the context of if you invested in stocks or markets, mutual funds, etc. Remember, you're only losing money on paper and it may seem super scary. But as long as you hold on, the market could eventually bounce back higher than the loss. And unfortunately, the biggest losers are the ones that aren't emotionally disciplined in times like these. So hold steady and let the markets do its thing over time. Timeless principle number 2 is be cautious of the headlines and social media. Now, I know you're on social media, YouTube, to get answers. And generally, it's the right move to stay informed, to increase your awareness of what's going on. But here's where that can fire back on you. Is everything on social media truthful and factual? No, not even close, not all the time. Therefore, be really careful about reading the headlines, especially on social media, even from people like me and my brother. I mean, I would say there were times where I was wrong. I mean, I'm a flawed human being like many. So while social media is great for staying informed and to learn, to grow your financial know-how, there's a little bit of a catch. A lot of the content creators on YouTube or similar platforms on social media are financially incentivized by clicks and views. So the more views means more money from potential sponsorships as well as ads for these creators. So more views typically means more money from sponsorships and ads for these creators. And it's totally in the realm of possibilities that they'll hype up the drama a little bit, making things seem a little bit worse than what they are to grab your attention. And not surprisingly, the major news networks do this too. I mean, I'm not saying that they're all bad people, but just know their incentives. So take what you see online with a grain of salt, even this very content. And like Lincoln said, don't trust everything you read on the internet. Third principle is to focus on paying off your debt. It means credit cards, consumer loans, or your mortgage, all of it. In every economic meltdown, the first people to get hit hard are those with uncontrollable debt. Think about the 2008 Great Recession. Sadly, the families with the greatest amount of debt were the first ones to experience the downward spiral into financial crash. And businesses have suffered the same fate as well. The fundamental rules when it comes to the game of money is to stay in the game. What will take you out of the game the fastest is uncontrollable debt. Now, I don't believe that all debt is evil. That's kind of like saying that all knives are evil just because it's an accessory often used by criminals. Now, I think greed and irresponsible use of debt could be said to be evil. But saying all debt is evil? Well, I kind of think that actually disempowers people from expanding their perspective and education when it comes to finance. So ultimately, paying off debt faster could, yes, save money on interest, but what really gives you is the peace of mind, especially if your income takes a hit. So by decreasing your debt or not having any debt at all, you have less risk of losing your home, the car, or other assets that you worked hard for. Fourth principle is to make sure that you've got access to cash and what I like to call liquidity. Yes, you should have at least 6 months of expenses saved up, but I understand that not everyone has the ability to do this right away. So if you don't, I suggest getting access to money at least through something like a line of credit. Now, I know it's not the most optimal path, but when things go south and you lose your income, you're not thinking about whether you're taking on more debt. You're stressed about paying the bills, utilities, the mortgage, putting food on the table. So having at least a line of credit, like a HELOC, gives you a buffer to hunker down during tough times. So in the event that you lose your income temporarily, you at least still have something to fall back on. In fact, here's a real life story of a client of mine during the pandemic. During the pandemic, she was furloughed from her job roughly 3 months. And in those 3 months, she didn't get a single dime for her income. But thank God she did have access to cash through her HELOC where she could pay for essential needs like utilities, mortgage, groceries, and gas for her car. Now, she did eventually end up getting back to work, but had she not had access to her HELOC, she would have been behind on her mortgage and her utilities, and she would have struggled to put food on the table. And down to the last and the fifth principle, which I think is the most important, is to get financially educated. Take the time to read, to learn, and maybe attend a course to grow your knowledge about money. And you don't need to be an expert in everything about finance. Just grasp the basic, like supply and demand, the time value of money, budgeting, simple investing principles, and how credit works. Then what I suggest is pick one investment strategy that fits your long-term goals. For me, I chose real estate investing, and I've been doing it for nearly a decade now, and I've seen how money is made and how it's lost, and it matches my risk tolerance and my goals. The best way to lower financial risk is to simply understand them. Sure, little hacks here and there to save money on groceries are nice, but what really matters and makes a big difference at the end of the day is how you think about your money over the long haul, not just saving a few bucks here and there at a grocery store. And I feel like this is the principle that a lot of people either don't act upon or delay because it puts the work and responsibility on them. And I really want you to pay attention to what I'm about to say, and that is no one is coming to save your finances. Not your government, not your kids, not your parents, and certainly not your boss. It is up to you to get educated and transform your thinking when it comes to your finances. Now, for my fellow believers with a faith background, do I personally believe that God provides everything and He's the ultimate protector? Yes. But Becoming a good steward of the resources you're given means you're actively taking the steps to learn and grow your understanding of finances. And here's a good example. King David, that we know about from the Bible, didn't magically get the ability to sling a stone at Goliath. He probably had years of training and practice. So if you're looking at it from a faith perspective, I think God uses people who accept the calling of preparation, because if the opposite is true, why doesn't God just automatically call people to do great, but they actively choose to be unemployed and stay at home to play video games? And I'm not saying that's a bad thing, but there's a balance to everything. So my point is that there's a part that we all play in the surrender, in the process, and the preparation. So there you go, my friends, 5 principles to protect your money during economic meltdowns. Don't panic sell, be careful with headlines, pay off your debt, get liquid, and educate yourself about money. If you apply these principles to your financial life, I believe that you'll lower the risks of getting hurt in a recession and during an economic meltdown. But not only that, you'll have a strong foundation and more of a wiggle room to invest, to grow, and even go on the offensive instead of always feeling like you're on the defense. So as always, if you enjoyed this video, leave a like and drop a comment down below, and check out this video right here, and I'll see you in the next video.